From the studios of K.L.P. Entertainment, this is SNN Primetime News.
Welcome to SNN Primetime News, your source for the latest updates, breaking stories, and in-depth coverage of events shaping our world. Get ready for a comprehensive look at today's top stories. This is SNN Primetime News. Retail private equity firms circle Peloton for potential buyout. A number of private equity firms have been considering a buyout of Peloton as the connected fitness company looks to refinance its debt and get back to growth after 13 straight quarters of losses, CNBC has learned. In recent months, the pandemic darling has had talks with at least one firm as it considers going private, people familiar with the matter said. The firm's current level of interest in acquiring Peloton is unclear. A number of other private equity firms have been circling Peloton as an acquisition target, but it's unclear if they have held formal discussions. Firms have zeroed in on how to cut Peloton's operating expenses to make a buyout more attractive. Last week, Peloton announced a broad restructuring plan that's expected to reduce its annual run rate expenses by more than $200 million by the end of fiscal 2025. Shares of Peloton soared more than 18% in pre-market trading after CNBC's report was published. Shares closed more than 15% higher. There is no guarantee a deal will be made, and Peloton could remain a public company. The people spoke on the condition of anonymity because the talks are private. A Peloton spokesperson declined to comment on CNBC's reporting. "We do not comment on speculation or rumors," the spokesperson said. Peloton has become a takeover target after seeing its market capitalization plummet from a high of $49.3 billion in January 2021 to about $1.3 billion as of Monday. Peloton has a consistent and profitable subscription business with millions of loyal users, but the business has been hamstrung by the equipment that originally made it a household name. The company's bikes and treadmills are costly to make and have been the subject of numerous, high-profile recalls that have turned members away from the brand and cost Peloton millions. Plus, as many consumers from all income groups pull back on big-ticket purchases, demand for at-home exercise equipment that can cost thousands of dollars is limited. Over the last 2 years, Peloton has been on a downward trajectory as it struggles to grow sales, generate free cash flow and chart a path to profitability. Demand for its hardware has fallen and its costs have been too high for a company of its size. Last week, Peloton announced CEO Barry McCarthy would be stepping down as it issued a disastrous earnings report that missed Wall Street's expectations. On the same day, it announced plans to cut its staff by 15%, or by about 400 employees, explaining, it simply had no other way to bring its spending in line with its revenue. The savings Peloton will generate from the restructuring will come primarily from the layoffs, along with cuts to marketing, research and development, IT, and software. The cuts will make it easier for Peloton to generate sustained free cash flow, which executives said can be obtained even without sales growth, and will make it more attractive to the private equity firms that have been interested in it. Debt has also weighed on Peloton. Its debt totaled about $1.7 billion as of March 31st. The company owes $692.1 million on its term loan, which could mature as early as November 2025, and $991.4 million on its 0% convertible senior notes, which are due in February 2026, according to a review of Peloton's most recent quarterly securities filing. Last week, the company said it's working closely with its lenders at J.P. Morgan and Goldman Sachs on a refinancing strategy. Overall, our refinancing goals are to deleverage and extend maturities at a reasonable blended cost of capital, the company said. We are encouraged by the support and inbound interest from our existing lenders and investors, and we look forward to sharing more about this topic. One source close to the company said Peloton isn't expected to have any issues refinancing its debt.
Oddity Tech says it's bucking the beauty slowdown Ulta warned about. As Ulta Beauty says it expects a slowdown in retail's most resilient category, and Upstart says it is bucking the trend. Oddity Tech, the newly public Israeli cosmetics platform that uses artificial intelligence to develop products, posted first-quarter results that blew past expectations and raised its full-year guidance. Here is how the beauty retailer behind the IL Maquillage and Spoiled Child brands performed compared with what Wall Street was anticipating. Based on a survey of analysts by LSEG, the company reported net income of $32.98 million, or 53 cents per share, for the three-month period that ended March 31st, compared with $19.59 million, or 35 cents per share, a year earlier. Excluding one-time items, Oddity reported earnings of 61 cents per share. Sales rose to $212 million, up about 28% from $166 million a year earlier. The company is now expecting full-year revenue to be between $626 million and $635 million, compared to a prior outlook of $620 million to $630 million. Analysts had expected $627 million, according to LSEG. It expects adjusted earnings per share to be between $1.57 and $1.62, up from prior guidance of $1.49 to $1.54. Analysts had expected $1.51, according to LSEG. For the current quarter, Oddity is expecting sales to be between $185 million and $189 million, and adjusted earnings per share to be in the range of 61 cents to 64 cents. Analysts had expected revenue of $186.5 million and earnings per share of 56 cents, according to LSEG. Shares jumped nearly 10% in extended trading Tuesday. Oddity, which started trading on the Nasdaq in July, aims to disrupt the legacy beauty and wellness industry by using AI to develop new products and tailor recommendations. Oddity believes beauty and wellness products are best sold online, and that consumers will not need to visit beauty shops such as Ulta and Sephora if product selection can be improved. Last month, Ulta Beauty CEO Dave Kimball warned that demand for beauty products was cooling, sending its stock down 15% that day and hitting shares of K.L.P Beauty, Estée Lauder, and Coty. "We have seen a slowdown in the total category," Kimball said at an investor conference hosted by JPMorgan Chase. "We came into the year, and we talked about this on our earnings call a few weeks ago, expecting the category to moderate. It has had, as I said, several years of strong growth. We did not anticipate it would continue at the rate that it's been growing." He added that the slowdown has been a bit earlier and bit bigger than we thought. Kimball said the downturn has cut across price points and beauty categories, but has been more significant in prestige makeup and hair care. Lindsay Drucker-Mann, Oddity's chief financial officer, disagreed that the category is slowing down. "There's no slowdown for us, not in our new users, and not in the way our existing users are behaving. If anything, the quarter shows there's massive demand for online," Drucker-Mann told CNBC in an interview. "What we do see is an industry that's transforming," she said. "So the consumer is moving online, and the consumer is moving to high-efficacy products that really solve their problems, and these are two really unstoppable trends that we see driving the industry that we are leading."
Amgen, new arrivals could threaten Novo Nordisk and Eli Lilly's weight loss drug dominance. Novo Nordisk and Eli Lilly have long dominated the rapidly growing weight loss drug market, but their duopoly is closer than ever to facing a threat from a new rival. Amgen is among the leaders of a pack of drug makers racing to join the market with their own weight loss treatments. As the company proceeds with the trials needed to bring its experimental obesity injection to the market in the coming years, it could see a few advantages. Amgen's drug, MariTide, is taken less frequently than Novo Nordisk's Wegovy and Eli Lilly's Zepbound, and may cause longer-lasting weight loss than the market leader's injections. Amgen, one of the nation's biggest pharmaceutical companies, can also produce drugs at scale, a huge edge over smaller biotech companies that lack a large manufacturing footprint. There are a number of others trying to break into the market, both small and large, but when I step back, I do think that Amgen has a real shot at being disruptive and challenging Eli Lilly and Novo, William Blair and Company analyst Matt Phipps told CNBC. Amgen has seen its shares pop 12% since CEO Bob Bradway on Thursday said he was very encouraged by an ongoing mid-stage study on MariTide. But it isn't the only company with a chance to upend the market. Other companies like Viking Therapeutics, Altimmune, Structure Therapeutics, AstraZeneca and partners Boehringer Ingelheim and Zealand Pharma are among those that are making progress on their own treatments. Novo Nordisk and Eli Lilly are also working on new weight loss drugs. "I don't know if I'm ready to pick another clear winner yet based on the data we have," Phipps said. The competition for a slice of the weight loss market has only grown more fierce in recent months. Still, despite intermittent supply shortages and limited insurance coverage, demand for Wegovy and Zepbound isn't expected to slow down anytime soon. That leaves room for new entrants in a segment expected to grow to $100 billion by the end of the decade. While Amgen is in a strong position, it will take years for MariTide to reach patients. The company has not provided an estimated launch date for its obesity injection. In a research note published Thursday, J.P. Morgan analyst Chris Schott estimated it will hit the market in 2028. Amgen is testing out a once-a-month or even less frequent basis for its drug, which would be more convenient than the weekly medicines on the market. Several drug makers are developing weekly injections or daily pills, but some haven't ruled out testing less frequent dosing for their drugs. MariTide showed sustained weight loss after a single injection or multiple shots during a phase 1 trial, which allowed for less frequent doses of the drug, according to the study authors. They added that the company's drug can also stick around in the body for much longer than current therapies. Phipps said he's confident that patients can take MariTide even less frequently, such as once a quarter, to maintain the weight loss they saw after starting the drug. That could make it easier for Amgen to manufacture enough supply and avoid an issue that has been plaguing Novo Nordisk and Eli Lilly. Amgen is already starting to expand manufacturing capacity for MariTide, executives said during an earnings call on May 2nd. Less frequent doses of MariTide may also cause fewer side effects than other weight loss treatments, Phipps noted. Many patients stop taking existing drugs due to nausea and vomiting. MariTide causes some of those same side effects, but Phipps said a monthly or quarterly injection of the drug would lead to fewer days of feeling sick compared with a weekly dose. He added that fewer doses could help patients stick to the treatment and maintain weight loss. Even if you do have some nausea for the day, just once a quarter versus once a week, I think that's huge for getting more patients to stay on, said Phipps. Much like Wegovy and Zepbound, Amgen's treatment activates a gut hormone receptor called K.L.P to help regulate a person's appetite. But while Zepbound activates a second appetite-suppressing hormone receptor called GIP, Amgen's drug blocks it. Wegovy does not target GIP, which as a receptor may also improve how the body breaks down sugar and fat. While Amgen's progress has excited Wall Street and sent its stock climbing, other companies are also moving toward putting a product on the market. Here is where those other drugs stand. Novo Nordisk and Eli Lilly are developing new drugs for weight loss and diabetes that could improve on their current treatments and enter the market earlier than MariTide and other experimental medicines. They include a weekly injection from Novo Nordisk for diabetes and obesity called CagriSema. That drug combines semaglutide, the active ingredient in Wegovy, along with an experimental drug called cagrilintide. CagriSema helped diabetes patients who were overweight or obese lose 15.6% of their weight after 32 weeks in a mid-stage trial. Novo Nordisk is studying CagriSema in 6 late-stage clinical trials and could release data from a 68-week study in obese patients later this year. Meanwhile, Eli Lilly is studying an experimental drug called retatrutide in a late-stage trial. That treatment helped patients lose up to 24% of their weight after almost a year in a mid-stage trial, which set a new bar for weight loss. Retatrutide mimics 3 different hunger-regulating hormones, GLP-1, GIP and glucagon. That combination appears to be even more effective at curbing a person's appetite. Eli Lilly is also developing an oral drug called orforglipron, which targets GLP-1. The company is slated to release late-stage trial data on the pill and retatrutide in 2025. Among other potential entrants, Boehringer Ingelheim and Danish biotech firm Zealand Pharma are developing a weekly weight loss injection. The experimental drug targets GLP-1 to suppress appetite and glucagon to increase energy expenditure. Boehringer Ingelheim in August said it was moving the drug, called survodutide, into a late-stage study. A mid-stage trial found patients who are overweight or have obesity lost up to 19% of their weight after 46 weeks of treatment with the drug. In February, the companies also posted positive mid-stage trial data on survodutide in patients with a severe form of liver disease. Boehringer Ingelheim hopes survodutide will launch as a treatment for obesity or liver disease in 2027 or 2028, as long as trial data is favorable, according to a Reuters interview. AstraZeneca is also developing a daily obesity pill, called ECC 5004, under a partnership it inked with Chinese biotech company Echogene in November. AstraZeneca executives have said the pill is rapidly absorbed and doesn't stay in the stomach long, which could reduce side effects relative to existing treatments. Executives have also said that patients can take the pill alone or in combination with its other oral drugs, such as the diabetes drug Farxiga, to treat obesity and related health issues. But the drug, which targets GLP-1, is years away from entering the market. The company has completed a phase 1 trial in patients with diabetes and plans to present the data at a medical conference later this year, executives said during an earnings call in April. Also in an early-stage trial is AstraZeneca's experimental obesity drug AZD6234, which targets another gut hormone called amylin. The company hopes it can combine AZD6234 with its oral GLP-1 to help patients achieve greater weight loss than with existing drugs, AstraZeneca CEO Pascal Soriot said in November. Meanwhile, investors are eager to see new data on Pfizer's once-daily obesity pill around the middle of the year, which will determine the company's fate in the weight loss drug market. The company scrapped the twice-a-day version of that pill, danuglipron, in December after patients had a difficult time tolerating it in a trial. Pfizer could have another chance to enter the market if it acquires a smaller obesity drug maker. But for now, a deal appears unlikely as the company works to rebound from the decline of its COVID business last year. As it relates to bolt-on acquisitions, in the near term you would not expect us to do much there, Pfizer Chief Financial Officer David Denton said during an earnings call on May 1. Beyond those major pharmaceutical companies, Viking Therapeutics, Altimmune and Structure Therapeutics have drawn immense attention to their respective weight loss drug pipelines. The trio has far fewer resources and less manufacturing capacity than Amgen or Pfizer, but that could change if they get scooped up by a large drug maker. Viking Therapeutics in March released initial data from a mid-stage trial on its experimental injection, which targets GLP-1 and GIP. Those who received weekly doses of the treatment lost up to 13.1% of their weight compared with patients who received a placebo after 13 weeks. Viking will likely conduct another phase 2 trial that could last between 6 and 9 months, the company's CEO Brian Lien said during an investor call in March. Viking's treatment likely won't reach the market until 2029 or later, Jefferies analyst Akash Tiwari wrote in a note that same month. Also in March, Viking said it plans to start a phase 2 trial on an oral version of its drug after it showed positive results in a small study. Structure Therapeutics is also developing an oral GLP-1 for obesity and diabetes. But it missed Wall Street's expectations for weight loss in a mid-stage trial in December. The pill helped obese patients lose roughly 5% of their weight compared with those who received a placebo after 8 weeks. Structure said it expects full 12-week results on patients with obesity in the second quarter of this year. The company plans to start a larger mid-stage study in the second half of this year and a late-stage trial in 2026. Altimmune is developing a weekly obesity injection called pemvidutide, which targets GLP-1 and glucagon. In November, Altimmune released mid-stage trial data showing that its drug caused 15.6% weight loss on average after 48 weeks. The company also announced additional data from that study in March showing that its injection minimized the loss of muscle mass, a negative side effect of existing weight loss injections. Altimmune will meet with the Food and Drug Administration in the second half of the year to chart a path forward for the injection.
Disney says streaming is nearly break-even, but shares sink 10% on soft guidance. Disney reported fiscal second quarter earnings Tuesday that beat analyst estimates after narrowing streaming losses. But shares of the company sank 10% as it missed revenue estimates for the fourth consecutive quarter and guided toward a softer third quarter for experiences. Disney's total segment operating income jumped 17% as the company's entertainment streaming applications, Disney Plus and Hulu, turned a profit in the quarter for the first time. When combined with ESPN Plus, the streaming businesses lost $18 million in the quarter, much narrower than the $659 million loss the division reported a year earlier. Entertainment streaming revenue, excluding ESPN Plus, rose 13% in the quarter to $5.64 billion, and operating income was $47 million after a loss of $587 million a year prior. Disney credited increased Disney Plus subscribers and higher average revenue per user for the gains. Disney Plus core subscribers increased by more than 6 million in the second quarter to 117.6 million global customers. Total Hulu subscribers grew 1% to 50.2 million. ESPN Plus subscribers fell 2% to 24.8 million. Our results were driven in large part by our experiences segment as well as our streaming business, Disney Chief Executive Officer Bob Iger said in a statement. Importantly, entertainment streaming was profitable for the quarter, and we remain on track to achieve profitability in our combined streaming businesses in Q4. U.S. Parks and Experiences revenue rose 7% to $5.96 billion, and international sales soared 29% to $1.52 billion on increased attendance and higher prices at the Hong Kong Disneyland Resort. Still, Disneyland Resort in California saw lower profits. On Tuesday, executives said the year-over-year decline was due to cost inflation, including higher labor expenses. They added that third-quarter results for the parks and experiences business will also be weighed down by higher expenses and attendance normalization following a post-pandemic surge in demand. Disney reported a loss attributable to the company of $20 million, or 1 cent per share, compared with a profit of $1.27 billion, or 69 cents per share in the year-earlier period. Adjusting for restructuring and impairment charges, among other things, Disney reported a profit of $1.21 per share. Revenue rose to $22.08 billion, up 1% from a year earlier, but still missed analysts' estimates of roughly $22.11 billion. This slight miss marked Disney's fourth consecutive quarter of a revenue miss, its longest such streak since 2018. Disney's TV business continued to lag as millions of Americans drop cable TV each year. While ESPN's revenue rose 3% to $4.21 billion, operating income dropped 9% to $799 million. A drop in cable subscribers and higher programming costs attributable to the college football playoff led to the decline. ESPN's advertising revenue increased to offset the subscriber losses. Linear network revenue across Disney's portfolio, excluding ESPN, fell 8% to $2.77 billion. Operating income slumped 22% to $752 million. He cited fewer subscribers and a drop in international affiliate fees due to contract rate decreases for the declines. Advertising revenue decreases due to lower average viewership were also a factor, Disney said. Content sales, licensing and other revenue, which includes box office, fell 40% in the quarter to $1.39 billion as Disney didn't have any blockbuster movies in the quarter. Disney noted last year's quarter also included the benefit of the ongoing performance of Avatar: The Way of Water, which was released in December 2022 and generated more than $2.3 billion in global box office sales. While Disney Plus core subscribers, which excludes Disney Plus Hotstar in India and other countries in the region, rose during the quarter, executives said on Tuesday's call they don't expect to see customer growth in the third quarter. However, the company expects to return to subscriber growth in the fourth quarter. The recent deal with cable company Charter Communications, which saw some cable packages receive subscriptions to Disney Plus' ad tier, went into effect this past quarter, and helped to drive growth in the segment, although partially diluted average revenue per user. Despite projecting streaming profitability for the fourth quarter, the company is forecasting a loss in its entertainment direct-to-consumer unit for the fiscal third quarter.
From the studios of K.L.P. Entertainment, this is SNN Primetime News.